I would like to welcome a well-known face around here, Andreas Traum from PwC. He will speak on the launch of Capital Markets 3.0. Welcome, Andreas.
Hello, everyone. So I have the pleasure of speaking directly after lunch, so you should all be well-nourished, probably a little bit sleepy, but that's good. That makes for very good listeners. So probably I'm expecting no questions. However, I'll also try to not make you fall asleep. I've kept the slides short and colorful. I hope you'll appreciate that as well. So after talking about the importance of education and crypto adoption in the segment before, in this segment now we'll be looking at how all of that correlates to digital assets as an asset class. So we'll be bridging the gap between the pure digital assets crypto space and capital markets. Briefly, at PwC, we develop services for our clients across all of our lines of service. So at advisory, assurance, and tax and legal, happy to explore any questions you might have afterwards. So to start, let me take you on a short stroll down history lane, looking at the ups and downs of capital markets, how they've fared so far. Starting at the very early stage boom era of Wall Street, pre-financial crisis, we saw investment banks succeed. This is the Gordon Gekko era of investment banking. We'll be looking at capital markets 1, 2, and 3 a little bit later. But with very complex instruments, very much catering to the sell side themselves, that they would benefit from it. And we saw return on equity pretty much above 20% across all asset classes. We then had the first fundamental dip, financial crisis of 2007, 2008, with Lehman and the aftermath that came afterwards. And we saw, for the first time, really, we saw markets freeze up at a global scale and liquidity becoming scarce. Governments across the world reacted with regulation, and all of the financial institutions, of course, good business for us, but they were busy implementing Dodd-Frank, MiFID, MiFIR, Basel III, and everything else. Implementing all of that and the limitation on liquidity saw ROEs drop for many asset classes well below 10%. The capital markets proved to be resilient. It took us maybe 2 years, but we did see a fundamental comeback. Global demand for capital, the rise of China as a world economic power overall, the global economic development, but also technology enhancements. They formed what we might refer to as capital markets 2.0, and we saw especially large globally active investment banks go back to very good profits and saw ROEs in asset classes go back to 12, 14%. Looking at the classic capital markets, the most recent dip, fueled by increasing global instability. We saw the start of trade wars, US, China. This is not even to mention what we're seeing now with the Ukraine situation. But the geopolitical turbulences impacted profitability for investment banks and hindered basically the growth of capital markets. We then added onto that the outbreak of COVID-19. Again, we saw a global lockdown, and I think at that time many people forecasted that we would be looking at a pretty long freeze and impact on global capital markets. However, quite surprisingly, I think through maybe some government programs, but we saw a very quick recovery, and we didn't have to go very far. Even in the second half of 2020, we saw global investment banks post record results that even preceded what they achieved prior to the financial crisis. So far, capital markets have been really resilient. I think the big question now is looking at, obviously we're at a crypto conference, so what's the further development? How will digital assets, how will the emergence of a new asset class impact capital markets? In other words, what will capital markets 3.0 look like? As I said, we're at a crypto asset conference, so let's take a look at the digitized world. I think what we might refer to as Web 1.0. Started in the 90s up to maybe 2005 around. We saw very much consumption-focused rise of e-commerce, but very one-directional business. But it was web-enabled, so that's start of digitalization in that sense of the business. We saw simple HTML pages. We compare that to capital markets 1.0, also very one-directional, very much focused on the sell side as well. We still had a lot of open outcry exchanges, very much dominated by big investment banks, by big capital markets. And what we saw, and we talked about the importance of education before, so also at that time, we started to have very, very complex products. No one understood them. If you looked at what happened, what caused the financial crisis of 2007, it's less and less people actually understanding what they were doing business with. Web 2.0, right? The evolution of the web, we're now looking at a more participatory style, moving away from simple HTML pages to web apps. I think a lot of more people become more interactive, but at the same time, it's very much big tech dominated, right? We have the Instagrams, Facebooks, TikTok, Google, Amazon really dominating, and in the end, the main benefit, if we talk economically, is again with big tech, right? Compare that to capital markets 2.0. We see an increase in STP processing. We see digitalization. Even the investment banks very much tailored products before, now looking very much more towards STP, having end-to-end, having digital channels out to the consumer. More bidirectional, but still participatory, but not collaborative. Everyone's talking about Web 3. What do we mean by that? We don't know, is it already started? When will it come? But here we're looking at making what is big tech dominated more collaborative, interoperable. We're looking at new applications coming up, metaverse. We have a demonstration outside. We're looking at virtual reality, augmented reality, sports and gaming coming up as key economic drivers. Even PwC is hosting the World Gaming Masters. I would have never thought that possible a few years ago. Very much an element of that for the true philosophers believing in Web 3 is disintermediation. We can take out a lot of the intermediaries. And of course, if we look at capital markets, where a lot of the entire value chain depends on being an intermediary and making a lot of money on that, the question will be, what will that mean for capital markets 3.0? We're already seeing the first centralized exchanges, Polkadot, Uniswap, taking up market share. We have DAOs, so completely self-governing organizations, no clear central management. Today, the question is, how does that work with the regulation that we have? How does that interact with existing regulation? And are we really there yet? When will we really get there, or will we get there? If we look at what is the true essence, why do we have capital markets? It boils down to capital markets' main reason is to connect people with liquidity. And when we look at digital assets, we believe they have the ability to democratize access to liquidity. And that can revolutionize capital markets as we know them today. That's whether tapping into the vast pool of illiquid assets, or whether it's fostering communities and bringing that collaborative sense that we expect from Web 3 to the capital market space. This has potential to revolutionize it. If we look at tokenization, it's not really decentralized finance, I'll give you that. But we have potential to tap into what today is illiquid and bring that into the capital markets value chain. Whether it's real estate, collectibles, data, intellectual property. And we're talking about NFTs, but we can tokenize so much more. We can take large investment, government infrastructure funds, break them down, make them accessible to the vast population. Recent study by BCG in this case estimates the total value that we can bring into capital markets by today illiquid assets to exceed $16 trillion by the year 2030. That is not far away, ladies and gentlemen. Decentralized exchanges, we do a lot of business obviously with centralized exchanges. I think they play a large part in bringing digital assets to a larger part of the population. We think Web3, we're talking about decentralized exchanges. Global market cap today is already at $100 billion US, with Uniswap, Polkadot, DYDX leading the game. With the crypto winter we're in, and we heard the numbers in the panel just before lunch, that's only 10% of the total global market cap for digital assets. So it's not just a niche element anymore. Another aspect that we also talked about a bit before the lunch break is looking at the impact of communities. Now, Web3 says we need to be collaborative. Everyone should be able to define what services they want, they get, and also benefit in them. So looking at how will communities affect capital markets? We're seeing the total trading volume. NFT had a big hype. We mentioned that in the panel I was on before lunch in 2021. That's gone down a bit, but still, if you look at the numbers, the total number of people actively trading has not really gone down. And estimates forecast that market very soon to be back at $20 billion US. Now, given all of that, in terms of the total capital markets is a fraction, but we're looking at crypto assets in total, how much they already impact capital markets. So I think these decentralized factors, we need to look at them and take them into account. Now, speaking for Big Four, obviously I need to mention regulation at least once. I love the slide, but I promise to try and not make you fall asleep, so I won't go through every bullet point on it. But I think what's interesting, and the main question, we put it in the title, is actually, does regulation have the ability to foster or hinder the spread of decentralization in our capital markets? I think what's interesting in this slide is to see the speed at which we're developing since we had the very first release of Bitcoin after the big financial crisis of 2007, 2008. And I know a lot of skeptics looking at it and saying, regulation is slow, is hindersome, is going to slow our progress. If we look at the right-hand side of this chart, we see those dots getting much more frequent in speed. And if we look at where we are today with regards to MiCA, marketing capital assets regime, in crypto assets regime, the development of that for the standards of EU regulation has been pretty quick. That still doesn't answer the question of, will it hinder or foster us in that trend? And I think that is to be seen. The clear answer to that is still out there. Right now, if we look at the regulation that we have, I think it favors, obviously, more the traditional or centralized finance. And in this form, obviously, we're already talking about centralized exchanges and crypto brokers when we talk about that. The regulatory frameworks that exist, obviously in place to some extent to protect consumers, but obviously they increase the barriers for even larger adoption of decentralized exchanges. Things like travel rule and transfer of funds regulation, again, make it much more difficult for institutions to offer more unhosted wallets to a broader audience. And obviously the whole spiel with KYC, KYB, I think every centralized exchange can sing a few hymns on that, is also still a hindrance. Technical providers, but I would add to that the large financial market infrastructure providers. We think they have a chance to gap that bridge between CeFi and DeFi. And if we see that the clients of traditional banks today can already access crypto products, and I think today's announcement, MasterCard together with Binance, is a perfect example of traditional finance moving at scale into that space. I think that's going to fuel the development much, much more, and that it gives a broader audience, a broader consumer base, the chance to tap into that market without themselves connecting to a centralized exchange. DeFi obviously has some advantages. We'll be hearing more about that later today. Consumers can interact basically globally, limitless, lower fees. At the same time, though, there's less regulation. It's very difficult to pinpoint if something goes wrong. We heard about Terra Luna earlier today. But if you're in a completely decentralized world, and today's regulation in Germany and in the EU still don't fully support that, it's a question of who do you actually make accountable. I think, and that ties us back to the chapter right before lunch, what's going to define that is really the demand by the mass population. For that, we need education. For that, we need mass adoption. I think once we see the benefit that crypto assets, not just purely as an investment vehicle, but as an asset class, front to back, can offer people in real life use cases, that's going to drive people's acceptance, that's going to drive demand and people wanting to use it. And I think that, together with the education that we talked about earlier today, can be a very, very powerful vehicle to further drive it. And that, ladies and gentlemen, I think can really define what Capital Markets 3.0 will look like. So that's, again, nothing that's going to come out of the universities, but it's going to be the market, and we're seeing that pick up in the way that consumers are interacting in Web3. That's going to define what Capital Markets 3.0 can look like. I think a main takeaway, we also need to come to the end, is really we should not be looking that much at the technology question when we look at Web3 or Capital Markets 3.0, but rather at what are the benefits, what are the functions that we expect this technology to deliver to us. And I think Alex mentioned it, Alex Höppner in a previous panel, but I've been saying that a lot. Maybe in, I don't know if it's 2 years or 5 years down the road, maybe we won't be talking about blockchain technology, Web3, and decentralized, centralized exchanges anymore. But it's not because it will go away, but because it will be inherent to people's everyday use, and we'll be using it wherever we go. And that's, I think, the one key chance to really drive mass adoption of the technology. And that's going to bring people very much closer to the capital markets, or they become one, as compared to what we saw in Capital Markets 1.0 prior to the financial crisis. I think with that, I think for the Web3 question, been hearing a lot that people refer to it as Web 2.5. I think what we're seeing right now is we're adding decentralized functions, a lot of the concepts that true DeFi wants to bring to financial markets or to the web ecosystem at all, and we're adding that to centralized functions. I think that's where we are now. I think that's a good development. And I think hand in hand, development of regulation together with consumer expectations and consumer influence in the market is going to define Web and Capital Markets 2.5, and in probably not so long future from now also what we will be then referring to as Capital Markets 3.0. With that, I think that's my cue to help you navigate. If you have any questions, obviously we're there to help you. And right now, with the last minute I think that I have, I don't know if there's any questions for those people that have overcome your post-lunch fatigue.